Hi, this is Peter Zamaya with No Option Antics, and here we will be talking about call options. And we're going to discuss what a call is and how a call operates. Now, first of all, a call gives you the option or the right to buy something at a set price by a set amount of time. Here's an example of a call option. And here's a home, and this is a beautiful home, and I'm sure that Parker Brothers designed this home here and made it part of the Monopoly game. But let's say this home is selling for $100,000, and you're considering buying the home. But you don't want to buy it until you get the opportunity to check out the area. So what you can do is you can make an offer to the owner of the home. Say, listen, I'm going to give you $2,000. If you take the $2,000, just take your house off the market just for 1 month. I want to buy the house for $100,000, but I'm going to give you this $2,000 up front right now, so I could buy the house maybe later on for the $100,000. Take it off the market for 1 month. So if the owner accepts this, then what you now have is a call option. You have the right to buy something, in this case the home, for a set price, in this case $100,000, for a set amount of time, in this case 1 month. Now, there's your call option in a nutshell. But consider calls like coupons. All right? If you have a coupon or an option to buy that house for $100,000, and sometime within the month that the house went up in value to $150,000, would you be willing to use that coupon? Well, of course you would, because if you could buy the house for $100,000 and it's worth $150,000, well, you're making out on the deal. On the opposite side is if you have the coupon to buy the house for $100,000 and the house sometime within that month was only valued at $75,000, would you want to use the coupon then? Well, of course not. Why would you pay $100,000 for something that's only valued at $75,000? So again, you have an option. That's why these things are called options, because you have choices here. You have the right, but not the obligation. When you own an option or you're long an option, you have the right to do something. You just don't have to do something. You only want to make a move with the option if it's advantageous to you. So what can happen? Well, if the value of the house goes down, you have the option or choice not to buy it. If the option goes up, if the house goes up in value, you have the option to buy it for $100,000, no matter how high it goes. If it goes to $200,000, $300,000, $400,000, your option gives you the right or the contract to buy that home for the $100,000. You can use the option only if it gives you a benefit. There would be no other reason to use it. Let's take a look at a risk graph. And in the risk graph, what I'm going to show you that is on the left-hand vertical column, these are dollars in a profit or loss. Along the bottom of the risk graph are the stock prices. And here we're examining a long $45 call, which we purchased for $5. Now when we're working with options, when we pay the premium, what they call the premium, we're paying on a per share basis. A call option in the U.S. has 100 shares per contract, so this would be $500 tied up in the trade. So you see that the most risk I have in this risk graph is the $5 I paid, because I cannot lose more than what I paid for the trade. But as the stock rises in value down here, we can see that my risk graph starts going in an upward direction. And you see that the break-even point happens to be right at the $50 mark. The reason why is we have the ability to buy the stock at $45, but we paid $5 for that right, so we have to overcome that $5 that we paid. Beyond that point, we have an unlimited upside potential, because no matter how high the stock goes, we can still purchase it for the $45, which is what our long call or owning the call has given us the right to do. Let's talk about real value. Let's talk about how we figure out how an option has real value. So let's look at a stock trading at $23, and I've listed several different call options here. We have a $10 call, $15 call, $20 call, $22.50 call, and a $25 call. And we're going to establish what the real value of each one of these calls are. So let's take a look. Stock's at 23. The $10 call gives you $13 of real value. Why? We can buy the stock at 10. Everybody else has to pay 23. The $15 call has $8 of real value because we can purchase the stock at 15. Everyone else has to pay 23. There's $8 of what's called real or intrinsic value. The $20 call has $3 of real or intrinsic value. The $22.50 call has 50 cents of real or intrinsic value because we can buy the stock at a cheaper price than where it is trading at. But the 25 call has no real value. Look at it this way. Why would you want to pay $25 for the stock when you can just go into the open market and buy it for 23? So that's the real or intrinsic value of the options. Call options are in contracts. They're sold in contracts. And in the U.S. market, you'll find that there are 100 shares in the U.S. and Canadian markets as well. If you're trading outside the U.S., it is best to understand the markets and what they trade, because in the U.K. and Australian markets, they have 1,000 shares in each one of their contracts. And this can make a big difference in your trading, because when you're trading, you're paying on a per share basis for the options, and it's quite a bit of difference to pay for 100 shares versus 1,000 shares. So just be aware of where you're trading and what amount of shares are in the individual contract. Join us for additional education here at No Option Antics, where we offer personalized coaching and a live trading experience where we go out and find trades and you follow in our footsteps to be able to see how to find, manage, and close trades. Contact us at info@nooptionantics.com or visit our website at nooptionantics.com. This is Peter Zamaya. Thank you very much for your time, and we look forward to seeing you again.